APOD. Sounds like a bug that's ruining your tomato plants. Actually, it stands for Annual Property Operating Data. It's a real estate form, a version of a profit and loss statement. But it's a little different from a standard business P&L. And if you're going to estimate the value of an income property correctly, you need to know how it works. I discuss the APOD frequently in my course on real estate investment analysis, and I invite you to watch a brief excerpt from one of my lessons. Hope you find it interesting. You may have, for example, vending machines, such as coin-operated laundry facilities in the basement of an apartment building. Or you may charge separately for parking in a commercial building. If you have these other items, then you can account for them here as additional income from the property. Put the two together and that'll give you your total gross income. And then, as I mentioned, we have a vacancy and credit allowance. Now, we could enter that in as a dollar amount, but quite frankly, when most investors try to do a pro forma analysis of a property, what they'll do is estimate a percentage of the total gross income that might be lost to vacancy and credit. And so what I'm going to do here is enter 4%, and I've structured the formulas so that it'll back into the dollar amount based on that percentage. And that gives us our gross operating income. What we want to do next is to account for the individual operating expenses. And I'm going to spare you the discomfort of watching me type a column of figures by opening up a second version of this file, this Excel file, into which I've already entered these operating expenses. Okay, I've made a fairly extensive listing of different operating expenses. You may not have quite as many with the property that you're dealing with, but I've entered dollar amounts for accounting and advertising and insurance and janitorial service and lawn and snow, all these things that you see here.